Let us read part A. Calculate adjusted present value for the project. So again over here, it is clearly mentioned that you have to calculate adjusted present value of the project APV. But if the question says evaluate the project, okay, if the question you will not use NPV. Okay, first of all, you will look for the conditions of APV. If those conditions are fulfilled, then you will use APV. Otherwise, you will use NPV. Now, what are those conditions? First of all, a heavy debt financing will be involved. Secondly, issue cost is presented. Okay, and what else? Yes, subsidy benefit. Okay, that will be given on the loan, right? Okay, so you have to look for those conditions. Okay, but over here it clearly states that you have to use APV. Calculate adjusted present value for the project, correcting any errors made in the net present value estimate above, and conclude whether the project should be accepted or not. Show all relevant calculation. So that is pure calculation. Only 15 marks. So they have basically computed NPV. So you have to make some correction in that NPV. Okay, and then you have to compute your APV. Part B. Comment on the correction made to the original net present value estimate and explain the APV approach taken in Part A, including any assumptions made. Okay, so you have to comment on the corrections. Okay, they have already computed NPV for you. So in Part A, you have to correct those errors, and in Part B, you have to comment on the correction made. And you have to explain APV approach taken in Part A, including any assumptions made. That is for 10 marks. Okay. You have recently commenced working for Burung company and are reviewing a 4-year project which the company is considering for investment. The project is in a business activity which is very different from Burung company's current line of business. The project is in a business activity which is very different from Burung company's current line of business. So it means company is going for diversification, right? Because it clearly states that it is in a business activity which is very different from Burung company's current line of business. So it means company is going for diversification. And even if right now if you're not able to pick this case of diversification, so the second hint is that if proxy company information is given, so it means you have to it means that is a case of diversification. The following net present value estimate has been made for the project. Okay, sales revenue, then they have deducted direct project cost, interest is deducted, profit, okay, that will give you the profit, then tax is deducted, investment cash flows, and they have done the discounting at 7% and then the present value. It says net present value is negative 1.65 million. So is this NPV correct? Is this NPV correct? No. So what are the mistakes they have made? Interest, right? Interest should not be deducted, right? Okay. So while computing NPV, we don't minus interest because its effect is already incorporated in discount rate. Okay. Okay, so right now I can just see one thing that they have included interest, so that is not right, right? So in part B, I have to comment, right? So I'm just telling you how you will comment. So you will tell your examiner that interest payment can never be included while computing NPV in order to avoid doubling. Okay, in order to avoid double counting. Okay, we don't include interest payment in NPV to avoid double counting. Because um, its effect is already incorporated in your cost of capital. So again, if I include that in my cash flows, so one thing will come two times, right? So how will you tell him that? You will tell him that we don't include interest payment to avoid double counting because its effect is already incorporated in cost of capital. Okay. Okay, NPV is negative 1.65 and therefore the recommendation is that project should not be accepted. In calculating the net present value of the project, the following notes were made. Since the real cost of capital is used to discount cash flows, neither the sales revenue nor the direct project cost has been inflated. It is estimated that inflation rate applicable to sales revenue is 8% per year and to the direct project cost is 4% per year. So I can see one more mistake. They have not inflated sales revenue and project direct cost. So now I will inflate them, right? I will inflate it. So for sales revenue, you have to inflate the sales revenue by 8% and direct cost will be inflated by 4%. The project will require an initial investment of 38 million. Of this, 16 million relates to plant and machinery, which for 4 million when the project ceases after any taxation and inflation impact into account. So for this project, you need a total investment of 38 million. So out of this machinery, okay, total need 38 million, and out of this 16 million is required for plant and machinery. And then plant and machinery will be sold for 4 million. This is your scrap value. Okay. Okay, then third, tax allowable depreciation is available on the plant and machinery at 50% in the first year, followed by 25% per year thereafter on a reducing balance basis. Depreciation basis. Okay. Taking any depreciation in this calculation. Right? Depreciation is not taken into account. So again, this is a mistake. So I will rectify it. Okay, so now you will minus your depreciation. Okay, a balancing adjustment is available in the year that plant and machinery is sold. Now, remember in the last year we do some calculation. From net book value, we minus scrap value, right? So that is basically your balancing adjustment. We are doing the balancing adjustment. Okay. Burung company pays 20% tax on its annual taxable profit. No tax allowable on the remaining asset, and they will have a budget. So even we also know this thing that depreciation is only available on plant and machinery, and plant and machinery is costing 16 million. Okay, so you will apply this the depreciation percentage on plant, which is 16 million. Burung company uses either a nominal cost of capital of 11% or a cost of capital of 7% to discount all project, given that the rate of inflation has been stable at 4% for a number of years. Now, can I say that this point is irrelevant for me? Why? Because I have to compute APV, right? So first of all, I will compute base case NPV. In base case NPV, you will use KE as a discount factor. We don't use WACC as a discount factor, right? We use KE as a discount factor. So this information regarding your cost of capital, that is irrelevant for me. Okay. So it is not necessary that every time he gives you the information that that has something to do with the question. Okay. He may give you with some irrelevant information as well. Okay. Okay, then it says interest is paid on Burung company. Normal borrowing rate of 150 basis point over the 10-year government yield rate. Okay, interest is based on Burung company. Normal borrowing rate of 150 basis point over the 10-year government yield rate. So we just read this line carefully. He is telling you how you will compute Burung company's normal borrowing rate. it is 150 basis point over the 10 years government yield rate. So I just need 10 years government yield rate. If I know 10 years government yield rate, then I will increase it by 1.5%. Right? 150 basis point means 1.5%, right? So if you know 10 years government yield rate, you will increase it by 1.5%. That will give you with Burung company's normal borrowing rate. Okay. At the beginning of each year, Burung company will need to provide working capital of 20% of anticipated sales revenue for the year. Any remaining working capital will be released at the end of the budget. Now, I hope you are familiar with the working of working capital, right? Working capital and depreciation has not been taken into account in the net present value calculation above. Now, he is giving you the reason why they have not taken depreciation and working capital. Now, read the reason. He is saying that since depreciation is not a cash flow and all working capital is returned at the end of the budget. So in this calculation of NPV, they have not taken depreciation and they have not taken any working capital, because he is saying that depreciation is not a cash flow. And for working capital, he is saying that whatever I will invest in day one, all of that will be recovered at the end of the project life. So that's why they have not taken working capital into account. Again, this is incorrect, right? You will explain him that tax depreciation is relevant because it will decrease your taxable profit, right? Depreciation is relevant, right? Because it will decrease my taxable profit and therefore it will decrease my tax liability. But later on, after computing the tax, I will add back the depreciation because it is a non-cash item. Okay. If you just ignore your depreciation, so don't you think that your tax liability will be incorrect, right? So you have to take depreciation into account. Although after computing tax, we will add back the depreciation, but still I have to take depreciation into account. Otherwise, my tax liability will be incorrect. Okay. So this is the point you will explain for depreciation. Then for working capital, he is saying that working capital will be recovered in the end. So that's why they have not taken working capital into account. Again, this is incorrect. Because a company, they will arrange finance for working capital. Right? Whatever you will invest in T0, for all your investments, company will raise the finance, right? They will raise the finance for plant and machinery, for land and building, and even for working capital, which you will invest in T0. So we have to arrange finance for working capital, right? And then on that finance, I have to pay the interest as well. Okay. And that interest will result in tax savings. So don't you think that if I just ignore the working capital investment, then obviously your shareholders, they will ask you that why the interest payments are high, right? Because in your NPV calculation, they cannot see any such thing as working capital, right? So obviously for working capital, I will raise the loan. Then on that loan, I have to pay the interest, right? So when your shareholder, when they will look at your NPV, so don't you think that they will ask you that why the interest payments are higher? Okay. Then that interest payment will result in some tax savings. So they can even ask you that why the tax savings, from where are you getting those tax savings from? Okay. So the point is we cannot ignore working capital, although it will be recovered in the end, but still I have to include it in my NPV calculation. Okay. Otherwise, it will be very difficult to justify. Okay, so you have to include your working capital in your NPV calculation because I need to raise finance for working capital. Okay, then on that finance, I will pay the interest. And that interest will even result in some tax savings. Okay, so if you don't incorporate your working capital, then all your working will be incorrect. Okay. Okay, then it says it is anticipated that the project will be financed entirely by debt. The project will be financed entirely by debt. So can you see a heavy debt financing is involved? All of the project will be financed through debt. So this is the condition of APV, right? So I can see this condition being fulfilled. Okay, although in the requirement it was clear, but still, if it is not clear in the requirement, then you will look for the conditions, right? So as you can see, the condition is present. Okay, and there's a heavy debt financing involved. Okay, it is anticipated that the project will be financed entirely by debt, 60% of which will be obtained from subsidized loan scheme run by the business, which lends the money at a rate of 100 basis point below the 10 years government debt yield rate of 2.5%. Okay, so first of all, I can see a heavy debt financing is involved. Then can you see the government, they are giving you with a subsidized loan. So the second condition is also fulfilled, right? I can see a subsidized loan over here. Okay. So 60% of which will be obtained from subsidized loan. So subsidized loan is only available on 60% of the finance required. Okay, it is only available on 60% of the finance required. In the previous question, subsidized loan was available on 80% of the finance required. But over here, it is available on 60% of the finance required. Okay. Then he is saying that 60% of which will be obtained from a subsidized loan scheme run by the government, which lend money at a rate of 100 basis point below the 10 years government debt yield rate of 2.5%. Now he is telling you how you will compute your subsidized rate. Government will lend money at 100 basis point below 10 years government debt yield rate of 2.5%. So government, so 10 years government rate is 2.5, right? Okay, 10 years rate is 2.5, and this government, they will lend you the money at 100 basis point below this. 100 basis point means 1%, right? So minus 1%. So it means they will give you the loan at 1.5% interest. Okay, they will charge you an interest of 1.5%. Sorry. Okay, so 10 years government rate is 2.5%. Okay, and government, they will lend you at 100 basis point below this rate. 100 basis point means 1%. Okay, so it means they will give you the loan at 1.5% interest. Okay, now I know 10 years government rate, right? So I can easily compute Burung company's normal borrowing rate, because if we just go and read this point, it says interest is paid on Burung company normal borrowing rate of 150 basis point over the 10 years government yield rate. So normal borrowing rate of Burung company is 150 basis point above 10 years government yield rate. So 10 years government yield rate is 2.5%, and they can borrow at 150 basis point over this rate. So 150 basis point means 1.5%, right? So add 1.5%. So it means they can borrow at 4%, right? Okay, then normal borrowing rate is 4%. This is the normal borrowing rate. So just note down this thing somewhere on your notebook. Okay, otherwise then you will be confused how we got this 4% or how we got this 1.5%. Okay. So normal borrowing rate of Burung company is 4%, and government, they have given you the loan at 1.5% interest. So it means my benefit will be, yes, my subsidy benefit will be, yes, my normal borrowing rate is 4%, and government, they have given me the loan at 1.5%. So I'm having a benefit of 2.5%, right? So this benefit is your subsidy benefit, 2.5%. Clear? Okay, then it says issue costs related to raising the finance are 2% of the gross finance required. So whatever I will invest in T0, that is the finance required. But I have to gross up that amount, right? So issue cost is 2%. So in order to gross up, you will divide with 98 multiplied by 100. Okay. The remaining 40% will be funded from Burung company's normal borrowing sources. Okay. So whatever finance is required for this project, 60% of the finance required will be financed through a subsidized loan. Okay, for 60% of the finance required, you're getting some subsidy loan. And for the remaining 40%, you will apply normal borrowing rate. On remaining 40%, you will apply normal borrowing rate. Now, can you see the level of repetition? Even in the last question, it was exactly the same. Okay. So in P4, there's a lot of repetition. Okay, then it says it can be assumed that debt capacity available to Burung company is equal to actual amount of debt finance raised for the project. Burung company has identified a company, Lento company, which operate in the same line of business as that of the project it is considering. So Lento company, this is your proxy company, right? So the second hint is also present. So it means 100% this is the case of diversification. Okay, Lento company is financed by 40 million shares trading at 3.2 each and 34 million debt trading at 94 per 100. Lento company's equity beta is estimated at 1.5. Okay, beta equity is 1.5. The current yield on government treasury bills is 2%. So yield on government treasury bills, that is your RF, risk-free rate. Okay. And it is estimated that the market risk premium is 8%, that is RM minus RF. Lento company pays tax at an annual rate of 20%. Okay, now just try to deal with this question. First of all, try to compute your base case NPV and then go till APV. Okay, so try to deal with this question on your own. Yes, try to compute your base case NPV first.
This conference will now be recorded.
Okay, so base case NPV. Life of the project is 4 years, right? So time T0, T1, T2, T3 and T4. Then you will write down nominal. Okay, so since we are ignoring 3 zeros, So in the bracket you would write down 3 zeros. Okay, so first of all you will write down sales. So for sales we have to do working 1. Working number 1, sales. So time will be T1, T2, T3 and T4. Okay. Now in this question revenue is already given, right? Otherwise I will take units into selling price per unit, but revenue is already given. But they have made one mistake, that revenue is not inflated. Okay, so it means first of all I have to inflate this revenue. Okay, so if we just look in your question, your sales revenue in A1, that is 23.03, then 36.60, 49.07, then 27.14. Now you have to inflate this revenue. Inflation rate for revenue is 8%, right? So you will inflate this thing at 8%. So into 1.08, then into 1.08 to the power of 2, then into 1.08 to the power of 3, 1.08 to the power of 4. So revenue will be, this is 24.87, then 42.7, 61.81, 36.92. Okay, so that is your working for revenue. So have you computed your revenue in the same way or made some mistake? Yes, is your working for revenue correct or did you make some mistake? What mistake did you make? Okay. Okay, so just quickly copy this thing. Okay, then after this, let us do a working for project cost. Working to project cost. So time T1, 2, 3 and 4. Again, they have given you with the direct project cost, but they have not inflated the project cost. So I have to inflate it. Okay. So direct project cost is for T1 it is 13.82, 21.96, 29.44, 16.28. And you have to inflate your project direct cost by 4%, right? So into 1.04, 1.04 to the power of 2, 1.04 to the power of 3, and to the power of 4. So it will be 14.37, 23.75, 33.12, 19.05. Okay, then in this project we don't have any other cost. Okay, we're only given with project cost. But they did one mistake. They have not deducted the depreciation. So now I have to do working for depreciation. Okay. So working 3 takes depreciation, time takes depreciation. So time will be T1, 2, 3, and 4. Okay. Now depreciation is only available on the machinery. What is the cost of machinery? That is written in point 2. 16 million, right? That is 16,000. Now for the depreciation, he told us that depreciation is available on the machinery at 50% in the first year. So it is 50% in the first year. That will be 8,000. Followed by 25% per year. Thereafter on a reducing balance basis. So in the first year it is 50%, and after that it is 25%. But that 25% will apply on net book value, not on the cost, because this is reducing balance method, not straight line method. In straight line method, you will apply your percentage on the cost, but in reducing balance method, we will apply the percentage on net book value. So net book value will be cost minus depreciation. That will be 8,000 into 25%, which will be 2,000. Okay. Then again you will apply 25%, but on the net book value. So now the net book value will be 6,000, right? So 6,000 into 25%, that is 1,500. And in the end, you have to do a working. You will take net book value. That is cost minus accumulated depreciation. You will minus depreciation for all the 3 years. Cost is 16,000, right? So minus depreciation for all the 3 years. That is 4,500, right? Net book value is 4,500. Then from this you have to minus scrap value. Scrap value is given in the question. That is 4,000, right? For machinery it is 4 million. That is 4,000. So leftover amount will be 500. You will write down this 500 over here. Okay. So that is your working for depreciation. Yes, it can be different for sales and cost. In fact, in almost every question, they are different. Done? Okay, so sales. That is in T1 it was 24.87, 42.7, 61.81, 36.92. Then you will minus project direct cost. That was your working number 2. It was 14.37. This is a cost, right? So an outflow 23.75, 33.12, 19.0. Now I will minus tax depreciation, working 3. So tax depreciation was, okay, that is 8,000. So I'm working in million, okay? So just take this thing as 8, then 2, then 1.5, and then 0.5. Okay. So we are working in million. So it is 8, then 2, then 1.5, then 0.5. Okay. So that will give you with your taxable profit. Okay, so tax is at a rate of 20%, right? Point 0.5. Then it is around 4. 5.44, 3.5. Now after computing the tax, I will add back the depreciation. Okay. Then you will minus your investments, capex. So for this project, you need a total of 38 million, right? Okay, you need a total of 38 million. So that will be shown in T0 as an outflow. Then your scrap value. Scrap value for machinery was, that will be 4. That was not, it is 16.95 into 20. Okay, so just take 3.4. Okay, 3.4. Okay, now scrap value for machinery is 4 million, right? So that will be that will occur at the end of the project life. There will be an inflow of 4 million. Then comes your working capital. Now we can directly compute working capital. There's no need to show a working for working capital. So for working capital, he told us that just go and read your point number 6, point 6. It says at the beginning of each year, Burung company will need to provide working capital of 20% of the anticipated sales revenue for the year. Any working capital will be released at the end of the project. So they will provide working capital of 20% of the revenue. So in T1, revenue is how much? 2418. So 20% of this will be invested in working capital, right? So for T1 sales, you will make investment in working capital at the beginning of T1, right? Beginning of T1 means end of T0. Okay. So 20% of this will be recorded in T0. So 24.87 into 20%. That is 4.97. Okay, 4.97 negative. Okay. Then in T2, revenue is how much? 42.7. So you will take 20% of this. 20% of this will be 8 point. That is 8.54. Okay, 20% is 8.54. Okay. So for T2 sales, you will make investment in T1. Right? You will make investment in T1. But you have to make a total investment of 8.54. So out of this, I have already invested 4.97. Right? This is the total investment required. But out of this 8.54, you have already invested 4.97, right? So it means I will invest the additional amount. So additional amount will be, let's take the difference, 3.57. So that will be recorded in T1. Okay. Then in T3, revenue is 61.81. So again, you will take 20% of this. That is 12.4, around 12.4. Okay. Yeah, so additional will be 3.82, right? And then in T4, revenue is 36.92. So take 20% of that. That is 7.38. Okay, so you have to make total of 7.38. So out of that, you have already invested 3.57 in T1 and 4.97 in T0. So additional investment required is okay. Now just look at one thing. Can you see your revenue for T4 is decreasing, right? My revenue for T4 is decreasing. So it means, your working capital, it will get recovered from T3 onwards. From T3 onwards, my working capital will start getting recovered. Because my revenue is decreasing, right? Revenue is decreasing. Okay. So now will you make any further investment in working capital? No. When your revenue will increase, then only you will make investment in stock, right? Working capital over here means stock. My revenue is decreasing. So will you make further investment? No. So it means that from T3 onwards, my working capital will start getting recovered. Okay. So from T3 onwards, your working capital will start getting recovered. So it will be a positive amount in T3. Yes, can you tell me what will be the amount? If you just take 20% of this 36.92, that will be, yeah. So that is going to be positive 4.98, right? Positive 4.98. And we all know that in the last year of the project, all of the working capital investment will be recovered. Okay. See, in T4, so revenue is decreasing, right? So will you make further investment in stock when revenue is decreasing? No. So it means from T3 onwards, your working capital will start getting, from T3 onwards, working capital will start getting recovered. So you will take 20% of 36.92. So 20% of 36.92, that will be 7.4, right? 7.4. So from this 7.4, you will minus all of these three things, okay, all these investments. So in the end, you will be left with positive 4.98. Okay. And in the last year, you have to show the recovery. So just net them off and tell me what is the net amount. That is 7.38, right? Positive 7.38. Okay. All these negative we added, positive 7 net them off. Okay. All these things will be net. You have to net them off. Okay. Okay. So you will net them off. That will give you with your free cash flows. This will be 42.97. Okay, now you will discount them. So we are computing base case NPV. So in base case NPV, you will use KE for discounting, right? So for KE, we have to do a working. So did any one of you computed KE? Okay, so let us do a working for KE. So KE is equal to RF plus RM minus RF into beta equity. But for APV, this beta equity will be replaced with beta asset, right? So for APV, KE is equals to RF plus RM minus RF times beta asset. Okay. So RF is given in the question. RF is, just read the last paragraph. Second last line. RF is 2%, right? Plus RM. RM is market return. But I told you that this RF minus RM, this is your premium. RM minus RF, this is your premium, right? So premium is already given in the question. Market risk premium is 8%, okay? That is your RM minus RF, 8%. Into beta asset. Now I need beta asset. So for beta asset, we have to do working. Now this is the case of diversification, right? So I will use proxy company data. Okay. So in diversification, you will do ungearing using proxy company data. But over here in APV, I will not do any regearing. Okay, you will just do ungearing. You will not do ungearing using proxy data. So you will use your beta equation. Beta asset is equals to beta equity into E over E plus D 1 minus D plus beta dead into D 1 minus D over E plus D 1 minus D. Okay. So beta asset is equal to beta equity. So you will use the information of proxy company, right? So for proxy company, they have already given you with beta equity. Just go and read last paragraph, second last line. It says Lento company equity beta is estimated at 1.5. Okay, beta equity is 1.5 plus E. E is market value of equity, number of shares into share price. Yes, so market value of equity will be, they have 40 million shares trading at 3.2. So into 40 million into 3.2, that will be 128 over E, 128 plus D, market value of debt. So Lindo company, they're having 34 million debt trading at 94 by 100. So book value is 34 and it is trading at 94 by 100. So 34 into 94 divided by 100. That is 31.96. So you can say that is around 32. 1 minus the tax rate. Tax rate is 20%, 0.2. Now nothing is mentioned regarding the beta debt, right? So I will assume that beta debt is 0. So this whole equation will become 0. So beta asset will be equal to, now whatever your beta asset will be, it must be less than 1.5. Remember I told you that this is one of the deadly sin. So you have to be a little bit careful. Right? And I even told you the reason behind this. Beta equity, that is a 2 risk beta. It represents two things: business risk and financial risk. While beta asset is a 1 risk beta, it only represents business risk. Okay, so beta equity, it will always be greater than beta asset. So my beta asset, it must be less than 1.5. This is 1.25, right? So just put this in your KE equation, 1.25. So KE will be equal to around 12%. Okay. Done. Okay, now let us do the discounting at 12%. KE, that is 12%, right? So factors are 1.893, 797, 712, and 0.636. Present value will be so base case NPV will be base case NPV is positive 8 point. Okay. So we have base case NPV, right? Now for computing APV, you will take base case NPV positive 8.63. Then you will add present value of financing cash flows. So in financing cash flows, we have issue cost, present value of tax savings from interest payment. Then we have present value of subsidy benefit after tax. Then we have present value of tax savings from issue cost of debt. Okay, and then your APV. So let us first talk about issue cost. Yes, issue cost is how much? That is 2% of the gross finance required, right? 2% of the gross finance required. So finance required for this project is, I told you, whatever you will invest in T0, that is the finance required. Right? So you will invest 42.97 in T0, right? 42.97. Okay, for this project, I need an investment of 42.97. But will you raise a loan of 42.97? No, I will raise the loan which is more than 42.97, right? I will raise a loan which is more than 42.97, because from that loan you will minus issue cost, and after deducting issue cost, you want to be left with 42.97. Okay, so it means you will raise a loan which is more than 42.97, right? Because after deducting the issue cost, I want to be left with 42.97. Okay, so I will gross up this amount. So issue cost is 2%, right? So in order to gross up, you will divide this thing with 98 into 100, right? That will give you 43.85. Okay, so this is the finance that I will raise from the bank. Okay, I will raise 43.85. Then from that I will minus the issue cost, and at the end of the day I will be left with 42.97, which I need for this project. Okay. Okay. So issue cost, that is 2% of gross finance raise. So gross finance raise will be 43.85. So 2% of this is your issue cost, right? Just take 2% of this. That will be around 0.88, right? 0.88. Okay. So issue cost, this is an outflow, right? So I will write it as an outflow. Okay. You will write it in negative. Yes, any problem in this working? Okay, now next we have to compute present value of tax savings from interest payment. So let us do a working for this. Do write down your working number. Okay, you have to give proper reference of your working. So present value of tax savings from interest payment. So again, that is very simple. First of all, I will compute interest payment. Then I will compute tax savings from interest payment. And in the end, I will compute present value. Okay. So first of all, we have to compute interest payment. So interest is paid on the loan, right? Interest is paid on the loan. So how much loan will you raise for this project? How much loan will you raise for this project? 43.85, right? 43.85. This is the loan that I will raise for this project. Okay. This is the gross amount you will raise for this project. Okay. So how much interest will you pay? On the whole loan, will you pay the same interest? On the whole loan, will you pay the same interest? No, because there was a subsidized rate, right, available on the loan. So subsidized interest rate was, we have already computed subsidized interest rate. Subsidized interest rate was 1.5%. Okay, that was 1.5%. And your normal borrowing rate is 4%. Okay. So will you pay this 1.5% on the whole amount of loan? Yes, will you pay this 1.5% on whole amount of loan? No. You will pay this 1.5% on 60% of the loan, right? Because the government have given you with a subsidy loan, which is only applicable on 60% of the finance required. Okay, so I will pay this 1.5% only on 60% of the loan, and on the remainder 40% of the loan I will pay 4%. Okay, I will pay 4%, which is my normal borrowing rate. Okay, so finance required is 43.85. So I will multiply with the interest percentage. So again, over here on 60% of the loan, I will pay subsidized rate, right? Subsidized rate is 1.5%. And on the remaining 40% of the loan, I will pay normal borrowing rate. I will pay my normal rate, which is 4%. So into 4%. that will be that is 1.09, around 1.09, right? Now I will pay the interest in each of the year, right? Life of the project is 4 years. So for all the 4 years, I have to pay the interest. Okay, interest is paid annually, right? Okay, so T1, T2, T3, and T4. So interest payment is 1.09. 1.09, okay, in each of the year. Okay, so this is your interest payment. Now next I will compute tax savings from interest payment, right? Because I don't need interest payment, I need tax savings from interest payment. So next I will compute tax savings from interest payment. Yes, so on this interest, how much tax will you save? I'm paying 20% tax, right? So I will save 20% tax. Okay, you will save 20% tax. So just take 20% of 1.09. This is 0.218. 0.218. Okay, so this is your tax savings from interest payment 0.218. But I don't need tax savings from interest payment. I need present value of tax savings from interest payment. I need present value, right? Present value of tax savings from interest payment. So for present value, I need a discount factor. Right? For present value, I need a discount factor. So discount factor over here will be KD. Right? For financing cash flows, you have to use KD as a discount factor. And KD over here means normal borrowing rate. So what is Burung company's normal borrowing rate? Yes, Burung company's normal borrowing rate is 4%, right? 4%. So you have to do the discounting at 4%. Okay. So I will multiply with the discount factor. So that is going to be 0.962, 0.925, 0.889, then 0.855. Okay. So present value will be total present value will be total present value is how much? that is 0.791, right? 0.791. So around 0.8 you can say, or 0.8. Okay. Done. Okay, so that is 0.8. Positive, it will be positive 0.8, right? Okay. Then next we have to compute present value of subsidy benefit after tax. So again we have to do working. Okay, so again I will break this into pieces. First of all, I will compute subsidy benefit. Then I will compute subsidy benefit after tax. And in the end, I will compute present value. Okay. So subsidy benefit. Yes, subsidy benefit. Your normal borrowing rate is 4%. Okay. And government have given you the loan at 1.5%. Right? Normal rate is 4%. And government, they are giving me the loan at 1.5%. So this, the difference between these two, that is your subsidy benefit, right? 2.5%. Okay, that is a benefit for you, right? 2.5%. Now, will this benefit apply on the whole loan? Will it apply on the whole loan? No, it is only available on 60% of the loan, right? On 60% of the loan, I will pay interest at 1.5% instead of 4%. Right? So on 60% of the loan, I'm having a benefit of 2.5%. Right? On 60% of the loan, you are having a benefit of 2.5%. So subsidy benefit, that will be equal to, yes, this percentage will only apply on 60% of the loan, right? So you will raise a loan of 43.85. But this benefit is only available on 60% of the loan. So into 60%, multiplied by my benefit, which is 2.5%. Clear? You will get this benefit of 2.5% on 60% of the loan, not on the entire 100% loan. Okay? Because only on 60% of the loan I will pay interest less than my borrowing rate. Okay, less than my normal borrowing rate. Okay, so this benefit is only available on 60% of the loan. That is 0.66. Okay, so you will pay interest each year, right? So this benefit, this will also arise each year. T1, T2, T3 and T4. In each of the year I will be having a subsidy benefit of 0.66. Okay, so I have computed subsidy benefit. Now next I will compute subsidy benefit after tax. So subsidy benefit after tax. So in order to do after tax, just take 80% of this, right? You're paying 20% tax, right? So if you just take 80% of this, that will give you subsidy benefit after tax. That is 0.53. Okay. Okay, so subsidy benefit after tax is 0.53. But for APV, I need present value. Okay, you need present value of subsidy benefit. So for present value, again, I need a discount factor. So over here, I will use KD as a discount factor. And KD over here is 4%, right? Your normal borrowing rate, that will be used as your, that is your KD. So my normal borrowing rate is 4%, right? Okay. So factors are okay, so just multiply with the discount factor. And that will give you the present value. Total present value will be 1.92. Okay. Done. Okay, so 1.92. So again, this will be an inflow, right? 1.92. Okay, then next we have present value of tax savings from issue cost of debt. Now, nothing was mentioned regarding tax savings from issue cost of debt, right? So I will assume that issue cost of debt is not tax deductible. Okay, you will just write down this as an assumption in the exam. So just net them off. That will give you with your APV. That will be 10.47, positive 10.47. Okay.